Competition for capital is intensifying as AI megaprojects, heavy government borrowing, and even Bitcoin all pull on the same pool of liquidity, just as inflation and earnings data are about to hit. Welcome to vTalkInsight, Allocator's Lens Daily for August 27th, 2026, where we connect equities, rates, credit, currencies, and commodities into one coherent portfolio view. In equities, the core tension is a still powerful earnings cycle running headlong into a more demanding cost of capital and thinner liquidity. The broad bull trend is seen as intact, with many expecting indices to grind higher into next year. Yet the path looks choppier as attention shifts from company results back toward macro data and funding conditions. Second quarter profit growth near 30% for the S&P 500 is an unusually strong outcome outside a post-recession rebound, and that strength underpins the constructive stance on equities. Technology is central to that story. Sector price to earnings multiples have fallen from the low 30s to the low 20s since last October, leaving the premium to the broader index at its narrowest in a decade, even as earnings expectations for AI infrastructure leaders have been revised up by around 15 to 20%. NVIDIA sits at the heart of this narrative, with revenue expected to roughly double to around $92 billion and earnings projected well above $2 per share, while its forward valuation now sits below both the S&P 500 and even some consumer staples names. Options are pricing a roughly 5% move around the latest results, and chip stocks in Asia and Europe have already moved in anticipation, underscoring how one company's print has effectively become a macro event for global risk assets. Yet recent price action shows how fragile that leadership can be. Semiconductor shares have sold off despite broadly strong earnings and guidance, and even after beating lofty forecasts, NVIDIA has struggled to rally as investors react with classic sell the news behavior. That mix of strong fundamentals, stretched expectations, and profit taking points to an AI trade that is still central but increasingly vulnerable to any hint of disappointment. Beneath the AI-heavy headline indices, leadership is rotating quickly. Travel and leisure stocks in Europe are outperforming on the back of lower oil prices. While energy equities are under pressure, European software names have been hit by weak U.S. tech prints and downgrades, and Meta has rallied after a large legal settlement removed a significant overhang. Outside the U.S., European markets screen as relatively cheap, with earnings yields near 6% in the UK and Euro area, offering diversification from the narrow U.S. AI complex. The AI boom itself is becoming a double-edged sword for equities. Hyperscaler investment plans have surged from roughly $600 to over $850 billion for next year, with talk of $1 trillion the year after and a broader shift toward more capital-intensive business models. Alongside heavy government bond issuance and a busy calendar of new listings that creates intense competition for capital, raising the risk of liquidity disruptions in the second half of the year, even as fundamentals stay solid. At the same time, index volatility gauges remain subdued in the mid-teens, and index option protection is described as relatively inexpensive, a notable contrast with the elevated single-stock volatility implied around AI leaders. For equity allocators, that combination of strong but concentrated earnings, cheap insurance, and a more hostile funding backdrop makes upcoming macro prints and policy moves particularly important for direction. That takes us naturally to rates, where disinflation signals are clashing with a stubborn fiscal risk premium. In rates, the picture is a tug-of-war between softer recent inflation data and the reality that price growth remains above target against a backdrop of very large deficits. Headline and core personal consumption expenditures inflation are essentially unchanged and still above 2%. But core readings have come in slightly softer than expected, and inflation has eased for 2 consecutive months while wage growth stays subdued. Those trends support the argument that the central bank can credibly pause tightening at the next meeting if upcoming prints remain contained. Interest rate derivatives now assign a much lower probability to an imminent hike than they did a few weeks ago, and markets overall are pricing in only one additional move by year-end, signaling belief in a near-term plateau for policy rates. The counter-argument leans on still elevated core inflation around 3.3% and exceptionally strong nominal growth, with second quarter nominal gross domestic product running close to 8% annualized. Some see this combination as inconsistent with a lasting return to 2% inflation, and expect policymakers may yet feel compelled to tighten again later in the year, especially if upcoming data surprise on the upside. In the bond market, long-dated U.S. yields have stepped back from recent highs. The 30-year yield has fallen from around 5.35% to below 5.18%, helped by an 8% decline in Brent crude and broader expectations for slower inflation. And there's a growing view that 10-year yields may struggle to sustain levels much above the mid-4% area. Major dealers have shifted to expecting lower yields as inflation improves and prior bearish positioning is unwound, and current high coupons are increasingly framed as attractive compensation for risk. Set against that, the structural backdrop remains one of persistent fiscal pressure and heavy issuance. U.S. deficits are still widening. There is no detailed consolidation plan on the table, and political gridlock makes meaningful adjustment unlikely before the next election. So term premiums stay elevated even as inflation expectations cool. In Europe, sovereign yields remain above 4%, and France faces additional scrutiny as higher debt service costs, political uncertainty, and limited appetite for fiscal repair all push local yields higher. Those rate dynamics feed directly into corporate borrowing costs and credit conditions, which still look benign on the surface but hide growing late-cycle strains. Credit markets continue to signal resilience, with spreads described as extremely tight and demand robust, especially for higher-quality borrowers. With policy rates elevated, income-bearing assets such as bonds, infrastructure, and private credit now offer yields that in some cases rival equity returns, making income a critical anchor for multi-asset portfolios in an environment of weaker macro certainty. On the supply side, rising long-end yields are being driven not just by government borrowing, but also by corporates funding massive AI infrastructure plans. Investment-grade issuance is marginally crowding out demand for treasuries as strong balance sheets are used to lock in funding, and AI-linked deals are starting to show up in U.S. high-yield and loan markets, even if they have not yet meaningfully affected European risk premia. Risks are building around a sizable maturity wall, particularly in Europe, where loans and bonds coming due by 2028 are expected to push default rates from the low single digits toward 3 to 4%. Investors are responding by demanding more amortizing structures, especially from technology credits that face disruption from the AI wave, and there is growing caution around bespoke tech issuance even as sector spreads stay tight. At the same time, AI hardware is becoming a new locus of credit innovation and risk. Credit default swaps on NVIDIA have widened despite strong cash generation, and its graphics processors are increasingly treated as financeable collateral, with major lenders validating compute as an asset class. NVIDIA is offering guarantees to infrastructure developers that accelerate data center build-out without swelling its own balance sheet, and software improvements that extend the life of older chips bolster their residual value. Those structures may support further capex, but they also concentrate credit exposure in a single technology cycle, pushing some allocators to look for diversification and hedges in other parts of the capital structure and across asset classes. Foreign exchange markets tell a more muted story in the majors. The euro-dollar rate is holding around 1.16, even as central bank officials keep signaling a possible additional hike, suggesting that, for now, incremental hawkish rhetoric in Europe is largely priced in and not driving large currency moves. Digital assets are far less calm. Bitcoin has rallied roughly 25% in a week, briefly trading above 80,000 in its largest weekly percentage gain in 3 years, driven by renewed interest in the debasement trade, increased dollar selling, and growing optimism around regulation in the United States. Political endorsements, progress on legislation designed to clarify crypto rules, and efforts to regulate perpetual derivatives are all cited as catalysts that have spurred sizable inflows into major Bitcoin exchange-traded funds. This surge reinforces the idea that crypto, alongside gold, is becoming a release valve for concerns about long-term fiscal sustainability and currency value. With traditional foreign exchange pairs relatively contained, digital assets are increasingly where investors express stronger views on inflation, policy credibility, and the future role of the dollar. Those same inflation and credibility questions are also visible in commodities, particularly energy and food. Commodities round out the picture with a striking split between near-term relief and structural tightness. Crude prices have fallen for a third straight session, with Brent dropping below $90 and West Texas Intermediate around $80, as an Oman-mediated framework has temporarily reopened traffic through the Strait of Hormuz. The easing of immediate supply fears has helped pull long-dated Treasury yields lower and provided a modest tailwind to consumer-facing and travel stocks, while pressuring oil majors and broader energy equities. However, focusing only on crude misses the ongoing squeeze in refined products and natural gas. Diesel and gasoline prices on a barrel equivalent basis are running in the $160 to $174 range as multiple choke points converge, from Hormuz risks and Russian refinery outages to reduced Chinese product exports and 5 to 6 million barrels per day of refining capacity offline. Russia is considering extending its diesel export ban, and European natural gas prices are expected to reach 3-year highs this winter, raising concerns about household energy bills and headline inflation. The tightness is not limited to energy. Supply bottlenecks across agriculture and metals are underpinning a bullish stance on the broader commodity complex, with particular conviction cited in agriculture, gold, and silver, while copper prices have surged around 16% this year and are approaching record highs, boosting European mining equities and supporting regional sentiment. Taken together, falling crude prices contribute to disinflation and help ease pressure on long-end yields, but the stubborn strength in refined products, gas, and food-related commodities keeps the risk of renewed inflation alive. Energy flows through the Strait of Hormuz, decisions around Russian exports, European winter gas dynamics, and crop outcomes will all be key variables for both inflation paths and term premia. These commodity forces loop back into rates, credit, and equities, and will be central to the cross-asset narrative as we move through the remainder of the year. Stepping back across assets, equities are still supported by powerful earnings, especially in AI and select European value pockets. But that strength is increasingly constrained by a higher and more volatile cost of capital and by narrow leadership concentrated in a few megacaps. Rates sit in an uneasy balance, with disinflation and softer wage data arguing for patience even as large fiscal deficits, strong nominal growth, and energy bottlenecks sustain a term premium and limit how far longer-dated yields can fall. Credit remains tight and income-rich on the surface. Yet refinancing walls, AI disruption risk, and new compute-backed funding structures hint at more complex fault lines underneath. In currencies, traditional pairs are relatively calm, while Bitcoin's sharp rally underscores how digital assets are absorbing some of the pressure from fiscal and policy concerns. And in commodities, temporary crude softness contrasts with persistent tightness in refined products, gas, and key metals, keeping the inflation debate very much alive. For allocators, the key watch points are upcoming inflation prints, central bank communication, the evolution of AI capex and NVIDIA's ecosystem, and how energy and food prices evolve into the winter, because these factors together will shape the trade-off between growth, inflation, and liquidity across the major asset classes. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.